Welcome, everyone. Hope you're having a great Tuesday. Thank you so much for taking the time to join today's webinar. It is top of the hour. I do want to be respectful of your time, so we're going to go ahead and get started. I'm Reneika Lightbourne. I'm always truly delighted to have Chantelle Owens from the Georgia Tax Lien Bootcamp as our featured and guest speaker. So Chantelle, thank you once more for joining us today just to knowledge share.
Thank you, Reneika. Thanks for having me. It's always exciting for me to be here as well.
Yes. So Chantelle's going to cover, just kind of give you like the ins and outs of tax lien investing, some of the fundamentals in terms of, what tax liens are, why you want to, consider investing in tax liens, how to go about investing in tax liens, and where you can find them. But before I turn it over, I just want to give you a brief overview of what self-direction is, the steps to get started with us. If you have questions as we go, if you have questions, feel free to type those in the question box, and we'll allocate some time at the very end to get those answered for you. Again, my name is Reneika Lightbourne. I'm one of the business development professionals here at Advanta IRA. I've been with Advanta as an employee since 2019, but I'm also a client of Advanta. Prior to joining, actually, my story is as a client, I wanted to learn about tax liens, and Chantelle was actually doing a visit in office lunch and learn, and I, came here and learned about tax liens from her, and eventually ended up coming on board as an Advanta employee. If you have specific questions as it relates to doing a deeper dive or talking through your scenario, you're always welcome to give me a call, send me an email, or visit our website at Advanta IRA. Is a great resource for you. You can also schedule a consultation there as well. So just a little housekeeping before we get going. Just know that Advanta IRA, we don't give any tax, legal, or investment advice. All of the information that you're going to see presented today is just, again, educational purposes. So we encourage you to do your due diligence. You want to consult with your professional team, whether it's your CPA, attorney, or financial advisor, before making any investment decisions. So just 3 key takeaways. If this is a new concept for you, just know that any IRA or former employer plan qualifies to be self-directed. You choose the investment that works best for you. Today we're focusing on tax liens specifically, so you can elect to go out and buy a tax lien in your IRA and repeat that strategy. And then, of course, if there's any income generated from that investment, it flows back into your IRA. If there's any expenses associated with that investment, it will be paid out of your IRA. So as it relates to tax liens, if you got to pay property taxes, then that expense would be covered or paid through your IRA. So just a little history about us. We've been in business for nearly 20 years as one of the leading self-directed IRA administrators in the business. Our headquarters is in Largo, Florida, which is the general Tampa Bay area. Advanta has an office in Atlanta, which is where I'm based, but we do work with clients nationwide, as we have a little over $2 billion under our administration currently. Also, too, one of the ways we do set ourselves apart is providing our clients that one-on-one concierge-style service. So as a client, you have a dedicated person, a direct point of contact, but also to our educational platform, continue to bring you great educational content that features experts like Ms. Chantelle Owens, talking about tax liens or, whatever the other strategy may be for one of our other speakers. In addition to hosting weekly webinars, I would encourage you to, check out our events page. We do have a podcast. We also do what's called Pitch, Promote, Prosper, where we have, it's almost like a Haves and Wands. It's open to the general public. We've had a great response from that, so you're always welcome to check out our website, see what we have going on, and continue to attend. Just know that our webinars are recorded, so this will be uploaded to our video library, but also our YouTube channel within 24 to 48 hours. So exactly what is a self-directed IRA? Self-directed IRA just simply means that you, as the account owner, you have complete control over your retirement funds. You get to decide what is it that you want to invest in, so you're the decision maker. You also to really get to diversify your account. You're just not you're not stuck with just investing in the traditional stocks and bonds. You can use IRA funds to invest in real estate, whether it's a single family or a multifamily unit. You can certainly, like we're going to be talking about today, use retirement funds to invest in tax liens or tax deeds, notes and mortgages. Precious metals has obviously been a great interest lately with helping with hedge against inflation. You can use IRA funds to invest in oil and gas rights. The list goes on and on in terms of the opportunities available to you. So why do people choose to self-direct? You may look to self-direct for many different reasons. I'm just going to touch on three. One, it can be a new source of capital for you. If you have funds that's just, idly, sitting in jobs that you may have left, a few years ago, you can elect to roll those funds over from that former employer plan to put it to work or transfer from your existing IRA. So you don't have to take out take out from your personal savings or take out a personal loan. And then, of course, another reason is the ups and downs in the stock market. We all know what's currently going on where the stock market is experiencing a lot of volatility. So a lot of investors like to invest in alternative assets, specifically, real estate, or in this case, tax liens. Nothing is guaranteed, but at least with tax liens, there's an opportunity, depending on your strategy, to either, end up with a property or interest return. And that's one of the reasons why a lot of investors like to invest in tax liens in their IRA. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, it's the accounts that you're already familiar with in terms of it being a traditional IRA, meaning tax-deferred. You get the tax break up front, you pay the taxes later when you retire. With a Roth IRA, you're electing to do the opposite, where you pay the taxes up front, grow that account over time. Once you've reached retirement age of 59 and a half, you've had that account for 5 years. When you take funds out, you pay no taxes. If you are self-employed or you have a side business or a small business, you can look to self-direct a SEP, simple or solo 401k. A lot of real estate investors specifically like the solo 401k or the individual K because it has higher contribution limits. You have greater flexibility. Some smaller accounts that you can look to self-direct or combine with having multiple accounts. You can self-direct an educational savings account for your kids or your grandkids or your nieces and nephew to cover their educational expenses. You can also look to cover, to self-direct an HSA, and this is to cover medical related expenses. As long as you have a high deductible plan, you can look to include that as well. Any former employer plan, whether it's an old 401k or 403b or 457 or TSP, you can certainly self-direct those. Typically, the only restriction is if it's a current employer plan and you're not yet 59 and a half, most times that employer would prevent you from moving it. You can certainly check with them to see if they'll make any special exception for you to move a portion of it. But most times, if it's a current employer, there's some restrictions. The key thing to remember is the different contribution limits, and we'll touch on that shortly. Varies between the different accounts, and then with your Roth IRA, your distribution will be tax-free at retirement. For contributions for traditional and Roth IRAs, you can put in $6,000 a year total. If you're over the age of 50, you have the additional $1,000, so you can put in $7,000. For a SEP IRA, you can put up to 25% of your earned income, not to exceed $61,000. For a simple IRA, you can put in $14,000, where your employer can match up to 3%. With the 401k or solo 401k, you get to contribute twice. Once as the employee, and then you match as the employer. So you can put in up to $61,000. If you're over the age of 50 for a 401k, you can put in $67,500 for 2022. For ESA accounts, you can put in $2,000 per year per child. For HSA, again, having a high deductible plan. For an individual, you can put in $3,650. For a family plan, you can put in $7,300. If you're over the age of 55 for an HSA, you have the additional $1,000 catch-up. And then finally, when you're ready to get started with us, just know it's really quick, 3 simple steps. First and foremost, you'll fill out the appropriate paperwork to open up your account with us. We'll be able to guide you through that process. Step 2 is funding the account. So whether you're moving funds from that existing IRA, it'll be a transfer, or if you're rolling funds over from a former employer plan, it'll be a direct rollover. And or you can make an annual cash contribution as long as you have earned income. And then finally, step 3, start investing. What is it that you have an interest in? If it, getting exposed to a tax lien on a webinar like this, and of course, doing your due diligence, is it tax liens that you have an interest in? within tax liens? Are you looking to just get interest return? Or are you looking to acquire the property so you can turn them into rentals or fix and flips and so forth? With that, I'll go ahead and turn it over to Chantelle. So just bear with me one moment.
Thank you, Reneika. Let's see. Can you see my screen?
I sure can, yes.
All right. Hello, everyone. Again, thanks, Reneika. I'm so excited to be here. Good afternoon to everyone. And I'm going to go ahead and get started so we can get to the question and answers. Again, my name is Chantelle Owens. I am the CEO and founder of Georgia Tax Lien Bootcamp. And I'm here to talk to you today about tax liens. So the question that I always get is, how did I get started in tax liens? And I was actually on the opposite side, not as an investor at that point, but as a person whose property went into the tax sale. And Tasha paid $2,100 for a property that I owned that I had a mortgage on for $139,000. That I was upside down in because the property was worth about $100,000. So literally, Tasha walked into a property that had, $98,000 to $100,000 worth of equity, and here I am with an upside down mortgage. So I was intrigued by that, and already knew about tax liens, but got a chance to see that they actually were real and that they actually were working and really working against me. And so I wanted to be on the opposite side. So I began to study tax liens. I reverse engineered that process. And once I understood that process, I didn't have the money to get into tax liens because during that time, that was during the market crash of, 2007, 2008. And, at that time I had been a real estate investor and pretty much lost everything. So I didn't have the funds to get in tax liens. And so I just decided to start saving up my money. And, 1 month I just went to the tax sale and the deals were really great. So I decided to use my bill money to get my first tax lien property, because I understood that if I could get a property for $2,100 that was worth $100,000, then, I could easily get the bill money back. So, but not necessarily have that opportunity again. And so I just took advantage of that opportunity at the time. Tax liens have allowed me to leave generational wealth for my children. I have been able to, if you can purchase properties for $2,100, under $10,000, and have it be worth, $70,000, $80,000, $100,000, then you could see how you could accumulate both property and, wealth pretty quickly. And so that's what tax liens has allowed me to do. And so let's talk about tax liens. What exactly are tax liens? Basically, tax liens are simply the property tax bill from the county that has not been paid, and the county has turned that into a lien and placed that lien on the property in the deed record, so that if it's sold, that lien must be satisfied. If it's not sold, the county typically can then itself sell the property for the back taxes owed. And so that is typically, when you hear the word tax liens, what that means. Now, under tax liens, there are several different type of instruments. So once the county decides to sell that property, what is then handed to the investor that purchases that property, there are several type of instruments that counties use. So we'll talk about those. So the first is a judicial tax deed, which means that property has gone through a judicial process. It's gone through the courts, and the courts has now said that the county has the right to sell it. So in some states, it will be what we call a marketable title. And then also with judicial tax deeds, there's no interest gained. They typically are sold at a higher rate because the legal processes have already been done by the county. So the county is recouping that money, and now they can sell that property at market value. What most people are familiar with are what are called non-judicial tax deeds, which the county is selling the property, but it hasn't gone through any judicial process. And so when the investor purchases that property, typically at some point in the future, they will have to go through a legal process in order to have a marketable title. Again, with a judicial tax deed, there is no interest earned. Rather, you're getting the property instead of interest. Then you have redeemable tax deeds, and redeemable tax deeds are very similar to tax deeds in that they're a deed, they give you property rights. However, they leave an option open for the original homeowner to be able to come back and reclaim their property through paying what you as the investor would have paid at auction. And so that's why it's called a redeemable tax deed. If that original homeowner doesn't come and pay what you paid at auction plus whatever interest rate or penalties are delegated by the state law, then you as the investor, are able to, claim the property. Then lastly, we have what are called tax lien certificates. And this is often confused with the word tax lien, right? Because you see tax lien in it. So sometimes when people say tax liens, they automatically think of tax lien certificates. But tax lien itself is just the lien that's placed on the deed record. The tax lien certificate is what one would receive in states where tax lien certificates prevail. They would receive a tax lien certificate, and that certificate entitles them to earn interest. So it doesn't convey any property rights. It just allows the holder to receive interest, while they hold that certificate. So if a person wants to reclaim the property, they would pay that lien certificate holder what they paid at auction plus, any penalties, and then they would get their property back. Now, in some states, tax lien certificates, if they're not redeemed, the person can, apply for a tax deed in which that would allow them to then, own the property. So those are the differences between the different types of instruments that you would receive if you invested in tax liens. So why invest in tax liens? Well, we kind of touched on that earlier, but, just here are some other reasons. Selling the tax lien at auction is how counties continue to function. They, most county budgets are comprised of a high percentage of property taxes. And so if those property taxes are delinquent, then a lot of times governments will have a hard time functioning. So it helps those governments to continue function. You can purchase property for pennies on the dollar. Even in this market, where if you go to a tax lien sale, you may say, oh, wow, those are some pretty high prices. The prices that you see are still pennies on the dollar. So, I mentioned a $2,000, tax deed on $100,000 house. So, now you may see a $70,000 tax deed on a $300,000 or $400,000 house, but still pennies on the dollar. So the opportunities are still there. They may be at a higher price point, but it's still pennies on the dollar. So the return is still there. And then you can leverage, because you are buying properties for pennies on the dollars, then you're able to leverage that to grow your portfolio. So this is what I really loved about tax liens. Is at the time I first invested in tax liens, I was just coming off of being a fix and flip investor. And I was just, really accumulating, one door at a time. It was where when I got into tax lien, I was able to buy multiple properties at a time and without a mortgage. So it was able to help me leverage and compound a lot quicker. So a lot of people want the property, as did I when I first started investing in tax liens, but there is another side to tax lien investing, and that is the interest. And this typically does interest people who have retirement funds, because you may not necessarily want to be involved with the property. You know, you may not want to rehab it, or you may not want to be a landlord, or, you know, you may not want to have anything to do with that, but you want to take advantage of using that niche or that vehicle to grow your portfolio. So you can do that through being an interest investor. So here's just a few examples of, you know, states is 25% return in Texas. And these are not market based, these are state mandate returns, right? So that if you purchase a tax deed in Texas and someone redeemed it, in order to redeem it, they would have to pay you 25%. In Georgia, it's 20%. And in Georgia, it can increase. So within the first year is 20%, but as soon as you step into day 366, it becomes 30%. And so, you know, that's a significant rate of return. It's not one that you see. It's not a common rate of return, at least not, you know, state mandated. You know, you can see that in markets like cryptocurrency, but it's not guaranteed, like, you know, via state law. Arizona is 24%, Illinois is 18%, and that's annually. So that if the redemption period is, let's say, 2 years, then, you know, you can earn, you know, 36% on your investment. So just a couple examples. So this is a tax deed property that one of our students purchased in an online auction, and she purchased this property for $4,500, and the after repair value was $271,000. So, and this was a deed. So she, in this case, was able to get the property right away and begin rehabbing it, and, you know, have that value be there. So that just gives you an idea of, you know, the types of investments that you can make. Now, is this typical right now? No, but it very much still is happening. Tax lien investing is definitely a type of investing that, you know, you have to comb through to find these amazing deals, but it really only takes a few of these to, you know, see some significant, you know, change. So how do I know so much about tax liens? Just so you know, I gave you my background story, but you know, before I was a tax lien investor, I invested in a lot of other areas of real estate. I've done wholesaling, I've done fix and flip. I am also a landlord. You know, I have a rental portfolio that I accumulated through tax liens. You know, so every time I buy a tax lien property, I turn it into a rental property. And so over the course of those years, you know, after going through those market crashes and investing in tax liens, it actually helped me to accelerate my goal. And so I have, you know, really been investing in tax liens since 2009. And so that's really, you know, how I came to know so much about tax liens. So I'm not going to go through all this history. That's pretty much what it's saying. But I do want to say that, you know, tax liens, and I kind of went over this story already, but tax liens are um, definitely a vehicle that, when paired with your retirement account, can really take you far. Many of our students use their 401k or IRA to purchase tax liens. Some of them want the property, and some of them are strictly interest investors, and we've seen them grow their, you know, retirement accounts through tax liens. So I just want to leave you with, you know, 3 keys to freedom, and then I'm going to open it up for you to ask all your questions that you have, and then also I'll invite you out to a free tax lien webinar that we have that gives you more in-depth information as well. So here's like 3 big steps that were paramount to me creating wealth. One, I had to invest in my education, and particularly with tax liens, because it's such a intimidating and uncharted area that not a lot of people know about. And there's like a lot of legal mines to step on. And so if you don't know this up front, then you can, find yourself in a lot of trouble. I've often at the tax sales see people purchase properties that they're not going to be able to use, or when they go to pay for it, there's things they didn't know. Like, let's say here in Georgia, you can't do anything to the property. You can't rehab it. You can't rent it out. You can't live in the property for a year. You have to wait and then complete a legal process after that year. And so some people, I've seen them go and they're paying for the tax deed, and they're like, oh yeah, I'm about to rehab this property, and it's like, you're not going to be able to do that. And so you have to invest in your education when it comes to tax liens. So there's a lot of things you can and cannot do that may not just, be typical or common sense in real estate. Next, I would say, get a mentor, get somebody that has done what you want to do and help you shortcut that time frame to do it, And then lastly, just, networking with people that also have that same type of knowledge that you are looking to gain. So those are my 3 steps that I took, in addition to investing in tax liens, that helped me to create financial freedom and generational wealth for my family. So I'm going to invite you out to introductory tax lien boot camp. If you want to, you can scan this QR code, or you can go to that link. I'm going to leave this up. And then Reneika, I'm going to now open it back up to you for questions.
Okay, great. Thank you so much, Chantelle. Great knowledge, great insight. So yes, we do have questions. The first one is, how are states different with tax deeds, tax liens, and tax certificates?
All right. So each state mandates which type of instrument can be sold there. So typically, the majority of states only have one type of instrument. Like, for instance, in Georgia, we only have redeemable tax deeds. We don't have tax deeds, and we don't have tax lien certificates. Let's say in Illinois, they only have tax lien certificates. Now, there are a handful of states, maybe 5 states, that have more than one type of instrument. Like Florida, you can get a tax deed, you can get a tax lien certificate, and you can get a redeemable deed. So there are a handful of states, but it's really state mandated and regulated which type of instrument you get in a state.
Okay, next question is a comment, and then confirmation, and then a question. So Georgia has a 1-year redemption period, correct? And then what is Texas? What is Texas period, redemption period?
Yeah, so and I want to clarify that Georgia has a 1-year redemption period, which is 365 days, but I want you to visualize this concept, because a lot of people get tripped up on this concept. The redemption period actually is indefinite. It goes as long as there's no foreclosure on the redemption period. So the redemption period can last, 1 year, 2 years, 3 years, if the investor never starts the foreclosure process. The 365 days or the year just simply really applies to the investor. They can't do anything in that time frame. But once, day 366 hits, they can start a foreclosure process. Once they complete their foreclosure process, that terminates the redemption period. But if the investor waits 2 years to start, then the homeowner has that full 2 years to redeem. So I just want to make sure that people understand that, because a lot of people will buy a tax lien, and then when the year comes, they like, oh, the homeowner doesn't have a right to come back. Yes, they do, because you haven't completed your foreclosure to stop that right, to terminate that right. So I just wanted to make sure that that was understood. In Texas, there's 2 different redemption periods. There's a 6-month redemption period, and then there's a 24-month redemption period. And it's just based on homestead. If the original homeowner had a homestead, then it's going to allow them to have a longer redemption period. If they didn't, then it's going to be a 6-month redemption period.
Okay.
And let me just say, I'm not an expert on every state, so I wouldn't be able to answer. Like, I just happen to know Texas because I've invested there, and I know a lot of different states, but I don't know the exact laws on every state, just because I haven't invested in every state. So
Okay. Next question is, when you say tax lien, are you buying deeds or liens to convert to deeds or interest liens and obtaining the property due to non-redemption?
okay, so when I say tax lien, just imagine any other type of lien. You have a mortgage lien, you can have a creditor lien. So the tax lien is just the state's lien on the property, right? And that's what you're buying, is the state is selling you their lien on the property. Now, however they give you a receipt determines whether you have to function under a tax deed, a tax lien certificate, or a redeemable deed. And the difference between those is a tax lien certificate is not going to give you any property rights. And you yourself cannot convert these into another instrument. There's laws that say exactly what you have to do. So a tax lien certificate, if you hold it, you're never going to have physical rights to that property. You're only going to be entitled to interest. Now, if that state gives you a process to convert that or to apply for a deed, then you would be able to, apply for that deed. If it's granted, then you would be able to possess or own the property at that time. If it's a tax deed state, then going in, you already know that you're going to get the property, because that's what that instrument does. And then in a redeemable deed state, it's a 50-50 chance of you getting the property or interest. You're not going to get both. You would get one or the other. And that just depends on if the original homeowner redeems the property. If they redeem it, then you're going to get your money plus interest. If not, then you're going to be able to go through a foreclosure process to stop their right to redeem, and then be able to own the property.
Okay. Next question is, I know you just mentioned that you don't do all states, but by chance, what is the interest rate for Florida? I think it's 18%. Well,
because it varies. I mean, I don't know the rate, but I know that in Florida they have you have deeds and tax lien certificates, and a lot of things in Florida is done by the county. So I think it may vary, but I do know there is a county where it is 18%, which I believe is Dade County.
Okay. Next question is, how can I self-educate about tax liens in Nevada? Like, they live in Nevada, so they want to know, like, how can they go about educating themselves about it?
I know I'm going to sound biased here. Obviously, I have a tax lien education program, but if I had the opportunity to learn about tax liens from somebody who knew about tax liens, I definitely would have took that route, because I would have saved a tremendous amount of time and money. I personally don't recommend self-educating, because it's very similar to self-educating yourself on the law. Yes, you can practice pro se, but you're just taking some huge risk in doing so. But that being said, I mean, if you want to self-educate, then, going to your county, finding out the law, the tax lien law of your state, like literally reading the code, YouTube and Google as well. The hard part about that is that none of those methods are going to give you the pitfalls. Like, you're going to learn everything to do, but you're not going to learn what not to do. And it's the what not to do that's really going to keep you kind of safe. So, my recommendation is to find, if it's not us, a company that specializes in tax lien education, so that you're getting a blueprint.
Okay. Next question is, do you find most of your deals during the auction or after, meaning OTC, over the counter?
Well, typically what happens with tax lien investors is that over a period of time, they end up investing in the same area. It's just the easiest thing to do. So in my particular area, I have to go to auction. So I'm in Georgia. I wanted my rental portfolio to be close to me. And so Georgia, you have to go, the auction is on the courthouse step. That being said, just depends on what area you want to invest in. If they have over the counter, or if they have an online auction, like many of my students, they invest all over the nation. They have that, I'm a little bit older. I'm not trying to run around, but if you have that energy and that's what you want to do, they go to auctions, in different states. And so whether it's online, over the counter, or in person, they invest in those states.
Okay, so next question is, realistically, given the market right now, how much starting capital do you need to compete with other investors at auction?
By far, this is the hardest question for me to answer. If you've ever been to the auction, the nature of the auction is so unpredictable, from weather to how many people are there. I still have students who, last month I have a student who purchased, a property for $3,100. Then I have students who are purchasing properties for, 100 and 200,000. It just really depends on what area of the country you're in. Which auction in that state, how many people attended. I really don't have an answer to that question. I always tell people, you just have to get in, start researching, and you have to go with what you have, because that's the only thing that's going to help you see. Like, if you're going to a particular county, you're going to begin to have historical data to show you, like, this is what the bids are typically in this area, so just nationwide, there's no way for me to say. Now, I know that never satisfies people. So let's say if I was here in Georgia, I always tell students, if you have like $10,000, then you should be able to find a county here and be able to purchase a property, so I don't know if that helps, but
Okay, next question. It's a comment and then leads into the question. As I understand it, the primary strategy will be to invest in states that have favorable laws to get your money soonest, or possess the property in a short period of time. Is there any other strategies that you do to determine what property you would bid on?
So, it depends, once again, if you want to be an interest investor, you're going to go after properties that are more likely to be redeemed, which those are properties that have mortgages on them, or, they're in a higher income area where people have the means to redeem. Maybe they just forgot to pay their taxes. That happens a lot. Maybe they didn't know if they didn't pay, it was going to go to auction. So those are the type of areas. If you want the property, then you're going to invest in areas that, are more run down, or, where the property has been vacant for a while, those type of things. So it just really kind of depends on your investment strategy, because some people, obviously, they do want their return back quicker, but because it's such a high yield return, some people are just willing to wait that out. They're willing to wait, 2 years to get a 36% return, and they just let the money sit there, so that's another strategy. if you have a retirement account with, you know, a bigger retirement account, then you can kind of maybe afford to do that. If you're younger and you have more time to grow it, then you can just say, you know, I don't mind waiting, you know, 2 years, you know. So these are kind of like business, your own business rules that you have to make up.
Okay, so next question that came in is, how can I purchase these out of my self-directed IRA? What is the process? In terms of when you're looking to make an investment in your IRA, in this case, it's going to be tax liens. Again, first and foremost, you want to fill out the appropriate paperwork to get your Advanta account with us open, fund your account, whether it's going to be a transfer from an existing IRA or you're making an annual contribution to start brand new, or doing a rollover from a former employer plan. And then finally, step 3 would be making the investment. In this case, you can do it one of 2 ways. You can do it directly through the IRA, meaning, hey, you're going to go to a tax sale auction. In that case, you would tell Advanta in advance just so we can get you those cashier's checks. So when you go to the courthouse step, you have the funds there to be able to, if you have a winning bid, if there's any overage, like let's just say, hey, you have $10,000 Advanta, I'm going to the auction on the first Tuesday, we would send you those cashier's checks from your IRA account in advance. You go to the auction, you win a bid for $6,000. Well, you pay the county, you get the difference, and you send it back to Advanta to be put back into your account. So that's doing it directly through the IRA. You can also, and a lot of tax lien investors specifically like what's called checkbook control. This is where your IRA actually own a brand new LLC, not one that you personally or currently own, but you open up your account, you fund your account with us, but you also take the additional steps of setting up an LLC in whatever state you choose. You get to act as manager of that LLC, or you can have someone else act as manager, but essentially, ultimately, the funds from your IRA account just then move into an LLC bank, into a bank account that's associated with that LLC that you manage, you control. So when you go to the courthouse step, you win a bid, you can just send the money directly or pay the county as needed, as opposed to having Advanta send the cashier's check. With checkbook control, you just want to make sure you're maintaining or keeping track of everything coming in and out. Same rules apply. So that's the high level of it. You can certainly reach out to me and we can talk more. I like to fill in the gaps as it relates to whether you want to do it directly or indirectly through the LLC feature. Next question is, just bear with me one moment. Which books do you recommend to learn about tax liens?
Let's see. There's a book called The 16% Solution. And that's pretty much all I know in terms of books. There's not a lot written. I'm actually in the process of writing a book, but there's not much written on tax liens, to be honest with you.
Okay, and then to follow up on a comment, it was, so just to clarify, you cannot even start the foreclosure process for 1 year. That's relating to Georgia.
Correct. Most states have a mandatory period that you must wait before you start the process. In Georgia, you can start it on day 366, so you have to wait 365 days.
Okay. Next question is, what is the quickest step-by-step process to buying tax lien? I'm assuming they're talking outside of the IRA, and then they have a follow-up question as well.
The quickest steps to buying tax liens? I'm not for sure I understand that question.
Okay, let's go to the follow-up question is, what auction websites do you recommend to start looking at for tax liens to buy if you're doing over-the-counter?
Well, you really are going to have to go through the county. Some counties hire like a third party, auctioneer, but you would find that information in the county. So it's not like, you have like auction.com that does foreclosures. It's not going to be like that. You're going to go through the county. A lot of counties hold their own auctions. So once you pick that county, contact the county and then see and a lot of times this information is not easy to find through the county. So you really have to be persistent and diligent in finding that information out. I always call tax liens the secret billion-dollar industry because counties don't really make it that easy to go through this process. So, you just have to be diligent in finding that information. But that's how you're going to find it, is through the county.
Okay, I do have a next question, but I do want to apologize for any, someone mentioned that there's echo in the sound, so my apologies. It could be my headset. Question is, what is the best type of property to bid on? Is it just residential, land, commercial? Do you have a preference?
I can't really say the best, because I think it is preference based, but for me, when I wanted to grow my rental portfolio, it was single residential. But look, I wish I would have been able to take advantage of the commercial opportunities, but obviously they were above what I could bid on. But had I been able to, I think those would have been great investments. But now I really love land. I mean, it's just, you could just look over the last 10 years and you could just see examples of how it's becoming more and more scarce. So, that is what, and then it's the most affordable investment right now. I've seen somebody 2 months ago get a, half an acre for like $600. So, it's still a viable investment in places. So.
Okay, next question that came in is, what is a good strategy to identify a good county to invest in?
I think you have to consider your goals, your end goals. Like I said, I was a person who, as I was building my portfolio, I recognized that I didn't like to drive to meet contractors. I didn't want to drive that far to meet tenants, or agents. So I wanted my portfolio near me. So I invested in the area that I lived in. But other people will say, I have this money I'm ready to invest, and I'm willing to go wherever I can to get a great rate of return. Then other people are like, okay, I'm looking for the area with the best deals. So it just, you have to create that, based on your own business goals.
Okay. Question is, what happens to the original mortgage on the home?
Oh, good question. So in the case of a tax deed and a redeemable deed, those deeds are able to foreclose on the mortgage. So if you're the investor and you get a tax deed or redeemable deed and you begin to foreclose on the homeowner, you're going to also foreclose on anybody else who has a lien on title, because your lien is superior. It's just like if a mortgage company forecloses, it kind of moves everybody else out the way. Well, that's the beauty of a tax lien, is that it's a superior lien. It sits on top of all those other liens, and once you begin your foreclosure process, you're able to wipe those liens out off the title. So
Okay.
it basically becomes null and void.
Okay. So that there's a follow-up question that came. Are federal tax liens able to subordinate to tax liens as well, like government IRA type liens?
I'm sorry, can you repeat that?
So there was a follow-up question that came in. Are federal tax liens able to subordinate the tax lien, like the county?
Yeah, so the county tax lien supersedes the federal tax lien. It also supersedes the state tax lien, because the county is the owner of the land. So the federal government and the state government is not going to be able to come in and take that from the county. So when you buy those lien positions, you're buying the county's position. The only liens that supersede county liens are other county liens that have been placed on the property prior to your lien.
Okay, and then another question relating to liens came in. So the question is, do you automatically remove all other liens if you get the tax lien as superior? Is this the case always, or do you have to pay other liens to get ownership of the property?
Okay, so it doesn't happen automatically. And so I just want to be clear on that. There's a process that you typically have to go through, whether you are doing it yourself or you're hiring an attorney, which is like the foreclosure process. And then that's what forecloses on the other liens.
Okay. Another question is your training course going to be nationwide or limited to Georgia or other states that you're familiar with?
It's a nationwide training course. So we teach you, because the instruments are the same everywhere. It's just maybe the interest rate or some other processes are different. So we teach you, how to, depending on where you want to go, how to, go in that state and learn that process if it's not a state that, we go through in class. So you have that. Our students go everywhere and invest, Michigan, Florida, California, New York, Texas. So we give you the foundation and the system to be able to take that, wherever you want to invest.
Okay, so I think we're coming top of the hour in a few minutes, but I just wanted to, another question or comment that came in is, I thought IRS liens superseded everything. Is this not true?
No, it's not true. I have foreclosed on a ton of IRS liens. The IRS typically doesn't even want the property. They have a whole department that you send that foreclosure information to. So, yeah.
Would you have to settle the IRS lien, like whatever balance is?
No. Because see, the IRS lien, even though it's attaching to the property, is mostly it's really attaching to the person. It's that the IRS doesn't know that this person doesn't have ownership of this property anymore. So that's what that foreclosure department, when you send that information, that's pretty much what you're telling the IRS is that Jane Doe doesn't own this property. I have a tax lien. I need to release your lien, or I'm foreclosing on your lien. If you don't want your lien foreclosed, if the IRS actually wants that property, then they have to pay you what you paid at auction plus your percentage.
Okay. Next question is judicial or non-judicial, which one is better for new investors?
It just depends on how much money the new investor has. Like if you have a higher amount to spend, then judicial tax deeds are really great because you don't have to worry about any other legal processes. You get the property. It's just like buying a property on the regular market for a lower value. But a lot of people don't have the higher amounts, and that's why they like the non-judicial, because they're getting those for lower amounts. Judicial tax deeds are going to be closer to market value, maybe just under market value, whereas non-judicial tax liens are going to be, more pennies on the dollar.
Okay, I think that covers all of our questions. So let me just go ahead and, there's something else. Someone was just sharing some information. There's a book titled Investing in Real Estate Tax Liens and Deeds by Jermaine Burrell. So a question came up about a book earlier. So if you want to, let's see, just bear with me. I think that covers, if you have any other questions, definitely feel free to enter those in the question box and we'll get those answered for you. Chantelle, I know you have your upcoming, the introductory boot camp, so feel free to, if you're interested in it, definitely use the QR code or check out the website to register to attend. Yeah, I think that covers all of the questions that came in. Again, Chantelle, I really appreciate you always, taking the time to just come in and talk to our audience about tax liens and the opportunities as it relates to how you can go about purchasing tax lien, whether your strategy is acquiring, a rental portfolio or getting interest returns back. If you want to know more about self-directing as a whole, again, feel free to reach out to me. I'm happy to talk through your scenario with you.
Thanks for having me, Reneika.
Absolutely. So I'll go ahead and I'll be able to, the recording will be up in 24 to 48 hours. And as well, I have a copy of Chantelle's slides. So if you're interested or you want a copy, definitely feel free to reach out to me. With that, I hope everyone has a great rest of your day.